Investing can seem complicated, but it doesn't have to be. Mutual funds are like baskets holding different stocks or bonds. They let you invest in many assets at once. This helps spread your risk. It's like having a little bit of everything instead of putting all your eggs in one basket. Mutual funds come in two main flavors: index funds and actively managed funds. Understanding the difference is key to making smart investment choices. Both types have the same goal: to grow your money. They just go about it in different ways. Choosing the right type depends on your risk tolerance, investment goals, and how hands-on you want to be with your money. Let's break it down. Index funds are like autopilot for your investments. They aim to match the performance of a specific market index. This could be the S&P 500, which tracks 500 large US companies. It could be the Dow Jones Industrial Average, or even a global index. Index funds follow a simple strategy. They buy and hold the same securities as their chosen index. This makes them very hands-off. You don't have a manager making decisions. The fund simply mirrors the index. This set-it-and-forget-it approach has made index funds very popular. Because they don't require a lot of buying and selling, their fees are typically low. This can have a big impact on your returns over time. Actively managed funds are like having a personal chef for your portfolio. Professional fund managers research, pick, and actively trade stocks or bonds. They aim to beat the market and deliver higher returns than a comparable index fund. Think of it like a chef selecting the best ingredients for a dish. Fund managers use their expertise to make decisions. They decide what to buy, when to sell, and how much risk to take. However, this active management comes at a price. Actively managed funds typically have higher fees than index funds. These fees cover the costs of research, trading, and the manager's expertise. Section 4, weighing the pros and cons. Choosing between index funds and actively managed funds can be tricky. Let's look at the benefits and drawbacks of each. Index funds shine in their simplicity and affordability. They're a great option for hands-off investors looking for long-term growth. They also offer diversification and transparency. You know exactly what you're getting. However, index funds won't outperform the market. They're designed to match it, not beat it. This can be a drawback if you're seeking the highest possible returns. Actively managed funds offer the potential for outsized returns. If the fund manager is skilled, you could see your investments grow faster than with an index fund. They may also provide access to specialized investments or strategies. But remember, there's no guarantee of beating the market. In fact, many actively managed funds fail to outperform their benchmarks, especially after fees. Section 5. Making the right choice for you. So how do you choose? Here are some simple tips. First, consider your risk tolerance. If you're risk-averse, index funds' steady approach might be a better fit. Second, think about your investment goals. Are you saving for retirement or a down payment? Your time horizon matters. Third, factor in fees. Even small differences in fees can eat into your returns over time. Lastly, do your research. Understand the fund's strategy, holdings, and track record. The bottom line, there's no one-size-fits-all answer. The best choice depends on your individual circumstances.